You know that feeling when you buy a digital movie online? Like you click purchase, your credit card gets charged, and the film is just sitting right there in your library.
Right, yeah, it has your name on it and everything.
Exactly. It feels entirely yours. But then one day, you actually read the terms of service, or maybe the hosting platform just suddenly shuts down, and you discover you never actually owned a single frame of that movie.
Oh, man, yeah. You just bought a very expensive, highly conditional license to watch it on someone else's platform.
Yes.
Yeah.
And it's such a, well, you realize you confused the experience of having access with the actual legal reality of ownership.
It is a totally jarring psychological realization. I mean, you assume that because you paid the money, or, in professional context, because you did the work, you automatically possess the underlying asset.
Right.
But the architecture of modern business is just rarely that simple.
And that dynamic is the exact focus of our deep dive today. We are cracking open an internal playbook from a company called Groon Insurance Group.
Yeah, it's a fascinating document.
It really is. It's titled, Are You Truly an Independent Agent? And it basically serves as a masterclass in dissecting the hidden structures of the life and health insurance industry. We're looking at the critical difference between genuinely building a business and, well, simply generating highly profitable production for somebody else's empire.
Which is huge. I mean, whether you're a seasoned insurance professional reviewing your contracts right now, or maybe a brand new agent who literally just passed their state exam.
Or even just someone listening who's fascinated by the mechanics of business ownership and the gig economy.
Exactly. The implications here are profound for all of you. This text really forces you to look objectively at the fruits of your labor and trace the actual legal lines of ownership.
So, to really grasp the gravity of this, we have to look at the heartbreak that plays out in this field every single day. The text paints this incredibly vivid, almost painful scenario.
Yeah, it's brutal.
Picture an agent who has been just grinding for a few years. We are talking nights, weekends, answering frantic phone calls from clients right in the middle of dinner time.
Right. They've dedicated hundreds of hours to learning the complexities of these health and life insurance products.
Exactly. They are sitting at kitchen tables, looking families in the eye, and building these deep, personal, multi-generational relationships.
And I mean, those agents are doing the heavy lifting, right? They're counseling people through really critical, highly emotional decisions about their family's financial security.
Yeah, and through that immense effort, they genuinely believe they are building a book of business, which, in the insurance world is supposed to be your ultimate professional asset.
It's the whole point.
But then a shift happens. Like maybe the agent discovers a brilliant new health plan that would drastically reduce the premiums for their very best client, but their current agency setup restricts them from selling it.
Or perhaps they just decide it's time to leave their agency, hang their own shingle, and strike out entirely on their own.
Right. So they go to pack up their client files, ready to start the next chapter, and they hit an absolute legal brick wall. They discover this devastating reality. They do not own those clients.
Nothing.
Nothing. They cannot move a single family to a better plan. And if they leave the building, none of those relationships come with them.
The rug is completely pulled out from under them. All the relationships they nurtured, the trust they meticulously built legally, every bit of it belongs to the agency they worked for.
Okay, let's unpack this. Because to me, this is like spending years meticulously renovating and landscaping a beautiful house. You pour your blood, sweat, and savings into every single architectural detail.
You build the patio, you paint the walls.
Yes, only to suddenly realize, looking at the fine print of a deed, you built your dream home on land you are just renting.
Ouch.
And the moment the lease is up or the landlord changes the rules, you have to walk away with nothing but the clothes on your back.
What's fascinating here is the profound psychological trap of that scenario. It perfectly highlights the crucial difference between doing the day-to-day labor of a business owner and possessing the legal reality of an asset owner.
Right, they feel like an owner because they work like an owner.
Exactly. That agent did all the grueling work of an entrepreneur. They prospected, they sold, they serviced. But they unknowingly took on the ultimate vulnerability of an employee. In business, performing the labor and holding the equity are just entirely different things.
So true. And to understand the mechanics of how an agent actually ends up in that trap, the source document points to a massive fork in the road that dictates an agent's entire career.
Yeah, it breaks down into two distinct paths.
Right, and we need to decode the terminology here. So the first path is the true independent agent.
This is the unadulterated entrepreneurial path. In this model, an independent agent negotiates and holds direct contracts with the major insurance carriers themselves.
Right. The document specifically names titans of the industry here, like Mutual of Omaha, Aetna, Transamerica, and Cigna.
Yeah, the agent goes directly to the source. There is no middleman filtering the relationship at all.
And because that appointment is direct, the agent's book of business is a tangible legal asset. If they decide to retire in 20 years, they can literally sell that list of generating clients to another agency for a massive multiple.
It is real property.
It is. But then the document outlines the second path. The acronym is LA, which stands for Licensed Only Agent.
Right, so in the LOA structure, the agent holds a valid license from the state, but their relationship with the carriers is entirely mediated. They work under the umbrella of a larger agency, often called an upline.
So your ability to sell a Mutual Omaha policy doesn't actually come from Mutual of Omaha.
Exactly. It flows down through a massive corporate hierarchy.
Yeah.
Your commissions are split with the multiple layers of people above you, and most critically, the agency's name is on the legal ownership of the client, not yours.
Wow. And the text notes this LOA structure is the foundational business model for massive organizations, right? Like Primerica, Family First Life, and World Financial Group, which is often referred to as WFG.
That's right.
I have to push back here logically, though. Looking at those two paths side by side, if being an independent agent means you get 100% of the money, you hold direct contracts, and you build a sellable asset, why would anyone in their right mind ever choose to be an LOA?
It seems crazy, right?
Yeah. Why voluntarily give away pieces of your commission and the ownership of your clients?
We'd think it's a terrible deal until you realize what happens to a brand new agent on day one. Imagine walking out of your state licensing exam. You have a piece of paper that says you can legally sell insurance, but you have absolutely zero idea how to actually do it.
Right, you're just dropped in.
You have no leads, you have no sales scripts, you don't know how to navigate the complex software portals for 20 different carriers, and the prospect of full independence in that moment isn't liberating, it is paralyzing.
Yeah, I guess you are standing on an island, entirely alone, expected to figure out a highly regulated industry from scratch.
Exactly. The LOA structure is designed to solve that exact day one problem.
Yeah.
The agency steps in and provides a vital runway.
A runway, right.
They offer a comprehensive umbrella. They say, we will give you an established lead system, we will give you our proprietary sales scripts, we will surround you with a team culture, and we will handle the complex training.
So they are mitigating the new agent's risk of failure.
Yes, and in exchange for that massive operational support, the agency extracts value through commission splits and by retaining ownership of the book.
Here's where it gets really interesting, though. Reading through the Green Playbook, the central thesis isn't that the LOA contract is inherently evil or illegal.
Yeah.
I mean, the mechanism makes logical business sense for the agents.
Absolutely. It's a trade-off.
Right. The actual trap is the agent's ignorance of the contract they are signing. The betrayal happens when an individual operates for 3 years genuinely believing they are building an independent business, pouring entrepreneurial sweat equity into the role, only to find out at year 4 that they were just a producer feeding someone else's upline.
This raises an important question about informed consent in the workplace. How often do professionals, not just in insurance, but across the entire gig economy, prioritize immediate support mechanisms like leads, software, and training without calculating the long-term cost to their equity?
Oh, all the time.
It forces you to look at your own trade-offs.
And the mathematical reality of those trade-offs is just staggering. The source document does a brilliant job of taking the abstract concept of ownership and grounding it in the day-to-day operations of an agent. Let's look at how the money actually flows across 4 specific pillars, starting with the concept of the income ceiling and specifically renewals.
Renewals. They are the absolute holy grail of the insurance industry.
Tell me about it.
Well, when an independent agent writes a policy, they get an upfront commission. But as long as that client keeps paying their premium year after year, the agent continues to receive a renewal commission.
So it is genuine compounding passive income.
Exactly. Over a decade, an independent agent can build a renewal stream that pays them a massive salary even if they stop actively selling. But in the LOA model, the upline captures that value. The agent might get a split of the upfront commission, but the agency absorbs the long-term renewal revenue.
Which fundamentally alters the trajectory of a person's wealth. I mean, the agent does the initial labor of making the sale, but the agency reaps the decades-long passive reward.
Right.
And that flows directly into the second pillar, the reality of client ownership. Because the agency holds the renewals, they hold the legal right to the client. If an LOA agent tries to leave, the agency keeps the book to protect that revenue stream.
Yeah, and you also have to consider the third pillar, the mechanism of why agencies restrict what an LOA can sell. Product flexibility. As an independent agent, you are a true broker.
Meaning you can sell anything.
Pretty much. You can scan the entire market to find the perfect, hyper-specific policy for a client's unique health situation. But an LOA is strictly limited to the carriers their agency allows them to sell.
But why do agencies do that? If a better product exists, shouldn't the agency want their agents to sell it?
It comes down to the agency's business model. Massive agencies secure highly lucrative bulk volume bonuses from specific insurance carriers.
Ah, I see.
Yeah. To hit those massive aggregate sales targets and unlock multi-million-dollar bonuses for the agency owners, they have to funnel all their agents' production into just one or two specific carriers.
Wow.
It simplifies their mass recruiting training? Sure. But more importantly, it ensures the agency maximizes its override bonuses, even if it means the agent can't offer the absolute best product to the family sitting across the table.
That is a profound misalignment of incentives. The agent wants to serve the client, but the agency needs to hit a volume quota with a specific carrier.
Right.
This is the difference between an independent contractor who owns their own tools, dictates their own methods, and can take their specialized skills anywhere in the market versus a highly skilled factory worker.
That's a great way to put it.
Because the factory worker might make a fantastic wage on the assembly line, but they are entirely dependent on the factory owner's infrastructure. The day they step off the line, their income drops to zero, and they have nothing to sell to the next factory.
That is the perfect analogy for the final and most crucial pillar, exit value. If you connect the income ceiling, the lack of client ownership, and the restricted products, you understand why the LOA has no exit value.
They never built a transferable commodity.
No, they merely occupied a highly compensated job. The independent agent built generational wealth.
The document actually illustrates this compounding effect through a stark 5-year comparison. It's a literal tale of two agents that brings all these underlying mechanisms to the surface.
This part is really illuminating.
Right, so imagine two ambitious people getting their insurance licenses on the exact same Tuesday. They are equally motivated, equally charismatic, and they both put in grueling 60-hour weeks.
Let's follow Agent A first. They choose the LOA route with a massive national organization. The first year looks incredibly successful. A steady stream of leads is handed to them. They plug into energetic weekly training calls, and they generate consistent production right out of the gate.
They feel like they're winning.
Absolutely. But let's fast forward to year 5. Agent A has outgrown the nest. They want to start their own agency. When they attempt to leave, the legal reality of the LOA structure violently snaps into focus.
They are immediately hit with non-solicitation agreements. The agency sends cease and desist letters threatening legal action if Agent A even talks to the clients they personally signed up.
It's terrifying.
The chilling effect is absolute. Agent A has to make excruciating phone calls to their favorite clients, people whose kids' names they know, and say, I am moving on, but legally I cannot take you with me. Someone else from the company will be handling your policy.
Just brutal. 5 years of relentless relationship building is vaporized overnight.
Yeah. Now, trace the trajectory of Agent B, who chooses the true independent route. Their first year is undeniably harder.
Way harder. They don't have a corporate machine feeding them leads. They have to hustle, cold call, and stumble through complex carrier software entirely on their own.
But they secured direct carrier appointments from day one.
Exactly. And at year 5, Agent B decides they want to switch their underlying CRM software platform, or maybe move their entire operation to a different state.
The transition is seamless. Because their name is on the direct contracts, they pick up their entire book of business. Every single client comes with them.
Yep.
Their compounding renewals continue to flow uninterrupted into their bank account. Their savings are perfectly intact, and if they want, they can sell the entire operation for a premium.
So different.
So what does this all mean? I mean, the Gruen playbook forces you to confront a deeply uncomfortable truth. Both of those agents put in the exact same amount of sweat equity. They worked equally hard. But the architecture of their contracts dictated that their careers were not equally valuable.
If we connect this to the bigger picture, it is a masterclass in the power of delayed gratification and risk assessment. Agent B accepted a much steeper learning curve.
They took the hard road first.
Yeah, they took on the initial operational risk to ensure absolute legal sovereignty over their future. Agent A traded their long-term independence for the immediate comfort of a predefined runway.
For the agents listening right now, or really anyone operating as an independent contractor, understanding this trap is terrifying. But the document from Gruen Insurance Group doesn't just ring the alarm bell, It lays out a specific, actionable blueprint for taking control of your career architecture.
Which is so needed. And the very first directive they give is remarkably simple, yet universally avoided: pull out your existing contracts.
Yes. Read the fine print.
You have to read the fine print of what you have already signed. You need to map out the plumbing of where your commissions actually flow. And most importantly, the playbook challenges every agent to look their current agency owner in the eye and ask what they call the 3 questions.
Okay, here are those 3 questions verbatim from the text. Listen closely. Number 1, who legally owns my clients?
Crucial.
Number 2, if I decide to leave this agency tomorrow, can I take my book of business with me? And number 3, can I secure direct carrier contracts while remaining exactly where I am right now?
I mean, they are completely reasonable questions for any business owner to ask, but the answers you get will immediately expose the true nature of your professional environment.
This is exactly where the strategic pitch from Green Insurance Group and their founder, Don Levi's, comes into the picture. They argue within this document that the entire industry has been selling agents a false dichotomy.
Right, like you supposedly have to choose between the nurturing support of an LOA or the terrifying isolated freedom of an independent.
Right. And Gruen argues that choice is a lie.
They present a hybrid model designed to solve the friction of both paths. They offer a structure where agents receive direct carrier relationships and 100% of their commissions and renewals.
Meaning the agent unequivocally owns their book of business?
Exactly. But Gruen claims to overlay that independence with a family-like support system, the training and the culture typically reserved for captive LOA agencies.
Their stated motto in the document is, with us, you're more than insured, you're family.
It's a compelling pitch.
It really is. For agents who realize they are building a house on rented land and are looking for a new foundation, the document provides direct lines of communication. You can explore their structure at grueninsuregroup.com. That's spelled G-R-U-E-N-E insuregroup.com.
Okay.
You can call their office directly at 210-986-7103 or send an email to info@grueninsurancegroup.com. But honestly, even if an agent never contacts them, the value of this document remains tied to those 3 questions.
Without a doubt.
I have to ask you, the listener, are you brave enough to ask those 3 questions today, knowing you might uncover a reality that forces you to completely start over?
Because finding out that years of your labor belong to someone else is a bitter pill to swallow. It induces a kind of, professional grief. But the Gruen text is ultimately a document of hope. It explicitly assures agents that if the answers to those questions aren't what you hoped for, you shouldn't panic. You don't have to blow up your life today.
Right, take a breath.
There is almost always a methodical, strategic path back to true independence, provided you proceed with intention, precise timing, and a clear understanding of the legal mechanics at play.
As we wrap up this deep dive, I want to emphasize why we spent so much time unpacking the granular mechanics of the insurance industry. Even if you have never sold a policy in your life, even if you never plan to, this text serves as a universal warning sign.
Absolutely.
It is a critical reminder to never assume you own the asset simply because you performed the labor.
I want to leave you with one final thought to mull over as you go about your week. The illusion of ownership we've dissected today is highly visible in a regulated industry like insurance, but its mechanics are quietly running in the background of the entire modern economy.
Oh, that's an interesting point.
Think about the broader gig economy or the digital creator space. How many independent contractors, digital creators, rideshare drivers, or platform workers out there genuinely believe they are building their own independent empires?
Most of them, I'd say.
Right. They hustle for 5 stars. They meticulously curate their subscriber lists. They build intricate personal brands on social media platforms. They feel the exact same pride of ownership as Agent A.
But underneath the digital interface.
Exactly. Underneath the interface, they are bound by terms of service that function exactly like an LOA contract. The algorithm controls the leads, the platform restrains the product, and if they decide to leave, they cannot take their audience with them.
Wow.
We have to ask ourselves, in the pursuit of being our own boss, how many of us are actually just generating highly profitable, legally protected, and entirely captive production for someone else's platform?